Hello, everybody, and welcome to Vetted VA's mortgage market update for this week. It is the week of September 26th, and today is September 28th. And I am Helmer from Originator Success. I'm joined this week with Joy Francisco. Joy, please say hello and introduce yourself.
Hey, y'all. I'm Joy Francisco. I'm with Accent Mortgage. I have 5 kids. My husband and I are veterans, and we're happy to be here.
Awesome. And whereabouts in the country are you?
I am in El Paso, Texas.
Okay, so you're down in Texas. And everyone always says to me, because I wear a cowboy hat, everyone assumes that I am from Texas. Have they not seen the show Yellowstone? They wear hats up there too. But everyone always thinks I'm from Texas because I wear a cowboy hat. So,
Well, because
like, no,
everyone from Texas wears boots. Which, by the way, I don't own a pair of cowboy boots. Just so you know.
I've got enough for both of us. I think I'm up to 9 pairs of cowboy boots. So,
hey man, slow down.
Boot of choice is Tecovas at the moment. I got a few pairs of Tecovas coming in. So anyway, we've got a lot to talk about, everybody. Please go ahead and say hello. Let us know you're here. If you're here live, give us a hashtag live. Let us know. Definitely be a part of the conversation. We're going to talk today about a lot of the concern that's out there with where mortgage rates are, the fact that they've gone up very quickly. We're going to talk about why they've gone up very quickly. We're going to talk about why you may be getting rate quotes right now where the interest rate is requiring you to bring money to the table and what that means. And we're going to go deep in not only what I call the front end, meaning whereas you as a consumer get to kind of feel that pain, what it means to you, but we're going to go on the back end and we're going to talk about what's going on in the markets. I'm going to show you guys some charts and some graphs and some articles, and we may go a little long today, but I think this one's a really valuable one, especially on the replay. So if you're here live, definitely talk to us. Let us know that you're here. We got Dustin here. Dustin doesn't wear cowboy boots regularly either. But anyway, if you guys are here, definitely give us a hashtag live. Let us know that you're here. If you're watching on the replay, please go ahead and give us a hashtag replay. We do monitor this post, so go ahead and ask your questions, share your thoughts. We definitely want to know what's going on. But if you are watching on the replay, it's important that you just give us a hashtag replay so we can see that you guys are getting value out of it. And it's the reason why we spend the time, because if you stop watching, I'll stop coming. So it's really that easy. That part said, let's kind of give a quick recap on where we're at. So last week, rates got worse. And last week, I had said, if y'all remember, it was our best chance at seeing rates improve. We had the Fed meeting last week. And when we saw that Fed meeting, we have just taken a beating since the end of July. All of August, rates had gotten worse. Heading into September, rates had gotten worse. And when we got to this Fed meeting, I said, this could be our pivot point. And I handicapped it. It's a good thing I don't bet on football, Joy, because I'd be in trouble. Because I handicapped it at 80% likelihood that we would see things start to improve and about a 20% chance that things were going to get worse. And I don't know if I said it last week on the Vetted VA talk. I do a lot of these different videos. And I did say last week, though, if we did get worse, it was going to get really ugly. It was going to be a whole new level of ugly. And unfortunately, that's what happened last week. We actually had that Fed meeting. And the Fed meeting itself, things were a little bit volatile that day, but mortgage rates were kind of holding their own. But the next day, Joy, what was it like the next day?
So was it when it fell 143 basis points?
Yes.
All at once?
Yeah.
So, and we found out later that it hasn't happened like this since 1949. It was really bad.
They didn't even have computers back then. And that's actually a lot of what's changed things is globalization. Yeah. And I'm going to talk about that a little bit today too. So yeah, for those of you that aren't aware what that means, 143 basis points, that is when we look at the actual markets and these charts. And we look at the basis for mortgage rates. And we've talked about this before, but just a quick recap. Mortgage rates are basically formed from 2 parts for you as a consumer. You've got the mortgage rate market, which is how mortgage-backed securities, which are a particular type of bond, how they're selling and how much they're selling for on the back end. And we're going to talk a lot about that today. And then you've got the lender margin. How much money does the lender need to make to run the company and make a profit? And when you put those two together, that's where you end up with a mortgage rate. Now, the one is the same for everybody. Mortgage-backed securities are the same for everybody. We're all selling into the same market. But you as a consumer may see a difference in your interest rates when you shop around based on how much does that lender need to make? What does their margin need to be? Joy's got 5 kids, 5 kids got to eat. And, that's Joy's got to feed those kids. So, and the company she works for has to make money. And depending on how big that company is and how much additional levels of management and marketing and compliance, and that can make a difference on companies. So you'll see that some companies are a little bit leaner and can offer you a consumer a better rate, and some are going to have a slightly higher rate, and you have to decide what works for you. So anyway, going back on that, last week though was a brutal week, and we saw mortgage rates that have pushed up. This is a website called Mortgage News Daily. It's just a public website. You guys can go to mortgagenewsdaily.com, and I'm going to their mortgage rate section. And you shouldn't necessarily use this as the your only source for mortgage rates, if you will, but it does give you an indication of where they've moved, because it's consistently looking at the same information and it's kind of going from there. So if we look at this chart, we were earlier in the month, we saw these, high 5s into the 6s, and we were like, oh my goodness, this is ridiculous. And I had said many times, rates in the 6s are nuts. We shouldn't be here. And I told you guys months ago, oh, don't worry about rates in the 7s. Rates in the 7s, those are like, Bigfoot. People swear they see them, but we're not going to see them. Well, we're seeing them, and we're seeing them hard. And the reason that we're seeing this, for lack of a better way to put it, is because the markets are panicking. We're actually seeing traders panicking right now. And there are a lot of variables to cover today. So we're going to talk about what that panic looks like and where mortgage rates are now. How likely are mortgage rates to go down in the immediate vicinity? Let's talk about the next couple of days, the next couple of weeks into 2023. And what should you do as a consumer to try to put yourself in the best position today and in the future? So Joy, that's like kind of the idea that I was thinking we'd go with today. How does that sound to you?
It sounds good, but let's get hope in the picture, right? It's panic, or we can call it a reaction, right? It's a reaction, and it's a reaction in the negative, right? But guess what? I truly believe in about 60 days, maybe 90 days, definitely in February 2023, when the government calls what we're in a recession, I believe we're going to see a positive reaction. But that's probably getting ahead. But let's frame that a little differently. Panic or reaction? It's a reaction, right? Some people are panicking, but we can react. Let's react.
There you go. So we're going to react to the panic reaction of the market. So what we want to, I guess the first place to start with is, why did rates kind of jump up the way that they did? And I was showing you guys a chart a minute ago. Let's go back and let's kind of go through this chart. So what you're looking at, all these pretty little pictures here, these are Japanese candlesticks, and these are how we measure each day. Each individual stick measures each day's activity of mortgage-backed securities, particular bonds. Now, mortgage bonds, there's actually multiple mortgage bonds, and I'm going to try to write quick as I go through this and give you guys a visual. So mortgage bonds, the way that mortgage bonds work is, and actually, let me go back a few pages. We've explained this before, so let me just roll back here, and I'll give you guys my pretty artwork from last time. Okay, so you have to understand that here's you, the consumer, right? You guys have this lovely, this is you, and you're hanging out, and you either want to buy a house or you want to refinance. So you're either looking to buy that house or you want to refinance. But in order to do that, you need the money, right? So where's that money going to come from? Generally, you don't have a few $100,000 sitting around. Most of us don't. So you're going to need to go to a mortgage lender. And the mortgage lender, they could be a quote unquote bank like Wells Fargo. It could be a large bank that you think of as deposits and withdrawals, or you have mortgage lenders and mortgage brokers, and they're going to basically help you to obtain that money so that you could buy the house. Well, the problem is we're going to run out of money. You can't just keep lending over and over and over. Where does that money come from? How do we continue to have money? Because even let's say that you did go to a Wells Fargo, right? Let's say, let me go to one more sheet here. Let's say that you went to a Wells Fargo, and in the old days, the way that things worked is people would deposit, their bag of money, and that money would go into the bank. And this is my picture of a bank, not a jail, but yeah, they're kind of the same thing. And they would go ahead and put that money into the bank. And then let's say the bank was going to give them, let's say, a 2% interest rate on that money. And then the bank is going to lend that money back out again. Here's my money bag. And they're going to lend it out at, say, 5% to you to buy a house. So that is, in theory, what everyone thinks happens. Well, people put money in the bank. I've got deposit money. I've got checking accounts, savings account, mutual funds, money markets, whatever goes into the bank. Well, there's not nearly enough money that goes into any kind of a lender. And so what happens, and this is why we also have mortgage lenders, there is a much higher demand. So mortgage lenders, and a lender can be a bank, or they can be any other kind of company that is lending to you as a consumer. This mortgage lender, and since my artwork is not great, we're going to just say lender, what they're doing is they're basically going to, terrible picture, but you got it, Wall Street. They're going to Wall Street to get the money. Okay, they're going, and that's where all of these pretty candlesticks come into play. Because what happens is the lender is actually going to lend out all of these different mortgages. And we're going to just draw little square rectangles here. And let's say that this lender is lending out these 9 mortgages. And what happens is they're going to take this money, these mortgages, and they're going to actually, in order to get them to Wall Street, they're generally going to go through some kind of a securitization process. There's a middleman, and you hear names like Fannie Mae or Freddie Mac. I'm just going to write Freddie. So you guys hear about Fannie Mae, Freddie Mac. We also have, for your VA loans, there's actually Ginnie Mae, which is like their kind of their little sister that gets no love. And the lender is actually going through these sources where they're going to securitize those loans, and they're going to sell them on Wall Street. And basically through this process, the lender has to make money. Wall Street's going to make money. Fannie Mae and Freddie Mac are going to make some money. And eventually it gets to you and you pay the money. So this is how we keep liquidity in the housing market. This is how we continue to have money to lend every day, is that we have to continue going back through Wall Street. And then sometimes these mortgages get paid off, and et cetera, et cetera. So when we go to Wall Street, we have different coupons. And when we go and we basically securitize these loans, they're called a UMBS, which stands for, Joy, do you know? I'm sure you do. You don't have to, you have to, I mean, you can keep yourself unmuted unless you got a barking dog or something.
There you go. Cleaning ladies are here. Sorry.
Oh, okay. It's actually universal mortgage-backed securities. Yeah. Okay. So what happens, everybody, is let's say that you're going to buy a bond. Bonds are generally sold at $1,000, right? Oh, I got to go back to the other screen so you guys can see what I'm doing here. So if you're going to buy a bond, let's say that you've got $1,000. I've got $1,000 to invest. I want to do something with my money. Well, I could spend my $1,000 in stocks and watch it disappear today. That's kind of where we're at, right? I could keep that $1,000 as cash. And that's actually a big problem right now, but we'll talk about that one maybe another time. Or I could take that $1,000 and maybe I'm going to buy a bond. Well, if I want to buy a bond, what happens is the number one most protected bond is a U.S. Treasury. And the reason that a U.S. Treasury is the number one safest financial instrument is that your money, that when you buy this bond, that money is backed. That bond is backed by the U.S. government. So the U.S. government would have to default on their debt in order to not pay back this bond. So the U.S. Treasury is the safest. Now, right now, if we look back at this chart here, again, I'm going to take some liberties with this just to make it clear, but let's kind of break down. So treasuries, they go by yield. Whereas when we look at mortgage-backed securities, they go by how much you're paying for it. But let's kind of talk about the yield. The yield is how much money are you getting for that bond. So right now, let's say that the yield on the 10-year treasury, if you bought a 10-year treasury, and I don't know if, let's say you bought $1,000 worth, you would get a yield of 3.76. Okay, so that means that when you look at that treasury, here you go, you're getting a yield of 3.76. So basically, again, oversimplification, but go with me here. If you invest your $1,000, you're going to get an interest rate of 3.76% on that. And then at the end of the period of the bond, you're going to get your money back. You get all of your principal back. Okay. So what happens though, and the way that the reason these yields change is, or I'm sorry, let me explain one more thing first. Then, so that's a 10-year treasury. What we are doing, again, those are UMBSs, right? So these are mortgage bonds. Mortgage bonds are a close second on security. So because of the fact that it's a lot of mortgages that are put together, they're pooled. So we went back here and basically this lender is taking all of these mortgages and putting them together, and then they're securitized and they're pooled. So if one of these mortgages pays off early, and that might be because they refinance, it might be because they foreclose. If something happens to one, there's still all the rest of it. So there's that safety in numbers going on here for mortgage bonds. So mortgage bonds are also a very, very safe investment, but they're not as safe as treasury. So they generally are going to have a little bit of a better yield. So what happens is if I have my $1,000 today, I could go buy US Treasury and I could get 3.76% interest again. We're going to call that for a 10-year, meaning I get my principal back after 10 years. Oversimplification, but that's kind of, for this purpose, you guys will understand where we're going. So for mortgage bonds and the way mortgages work, well, right now, there's different coupons. There's a 5% coupon, a 5.5% coupon, a 6% coupon. And these mortgage coupons, if we kind of roll back, so right now, I don't remember if we went all the way down to 2. I think we did go down to 2. So let's say there's a 2% coupon. There's a 2.5. There's a 3. There's a 3.5. There's a 4. There's a 4.5. There's a 5. There's a 5.5. There's a 6. There's a 6.5. There's a 7. Okay, so there are actually all of these different coupons out there. They exist. And what happens is investors and traders are trading them. They're actually buying and selling them to each other as new ones are being made. Now, the new ones that we're currently making generally are falling around 5 to 6. And I'll show you that in a little while. But what happens is this is the interest rate, let's say, that you're getting on that $1,000. So if I'm getting 2%, why would I want 2% when I could get 4%? Or 5%. I mean, again, if I could buy the bond, if I could buy this bond for $1,000, and I could buy this bond for $1,000, and I could buy this bond for $1,000, why would I not buy the one that's got the higher interest rate? Well, because you can't buy them at $1,000. And that's where what we're looking at on the screen comes into play. And let's kind of roll back a page and I'll show you a little bit. So right now, if we look at that 5.0 coupon, your $1,000 would actually be $978. So you're actually getting it at a discount. So if we want that 5%, we're paying $978 and we're still getting $1,000 worth of the bond. The bond is a $1,000 bond, but we're paying $978. Well, what if we go to that 5.5? That one is $99.81. So this would be $99.81. And this one just went up to there you go. So we've got $99.81. Well, what about that 6% coupon? And we go here. So at the 6% coupon, this one, we would actually pay more. We're going to pay $1,106. Okay, there we go. There we go, $1,630. So we're going to pay $1,016.30 to get that same $1,000 worth here. Why are we doing that? Because it's giving us a premium. We're getting more interest, but we're paying a premium to get that $1,000 because we want to get that 6%. We get a discount for paying to get the 5.5. We get an even deeper discount at the 5.0. Now, I don't have them up on my other screen, but how much, as you see these continuing to go down, how much do you think right now someone is willing to pay for $1,000 worth of a 2.0 coupon when what else? Think this is where inflation has hurt us, because who wants a 2% rate of return? So nobody wants that 2% rate of return coupon because it's not even bringing in enough to keep up with inflation. So this coupon may right now, this one may be at $900. This one may be at $930. And again, these ones I'm making up, but you guys get the point, right? So what happens is on these mortgage-backed securities and on these mortgage bonds, as we call them, there is a price that they are selling for, and it's either a premium price or it's a discounted price. And that's where what you're seeing on your rate sheet starts to come in. So I'm going to pause for a minute. Joy, anything you want to add to this or any questions you want to ask to clarify looking at it from the outside in?
So when we say Wall Street is buying the mortgage-backed securities, who's the largest purchaser of mortgage-backed securities?
Well, at one time it was the Fed, and that was quantitative easing. Nice softball there, by the way. You're fun, Joy. Joy's got this. We have to have Joy on again because you get this. The Fed was doing what's called quantitative easing. And over the last couple of years with the pandemic, the Fed was buying up not all of, but they were buying the most of the mortgage bonds. And this is an important thing to talk about because the reason they were doing it is liquidity. In other words, these prices, they're actually all based on supply and demand. And that's why they actually trade, and we see them move this way, and why you see all these fancy red and green changes to the charts, right? Because let's say that Joy is willing to pay $980 for this 5.0 coupon instead of $978. So what happens is when there's more demand, the price goes up because there's less supply and there's more demand. That's going to bring the price of those coupons up. And as these prices go up and we kind of keep going into these lower interest rates with those premiums, that's what brings mortgage rates down. And that's, again, kind of setting us up. So the Fed was the number one purchaser. And when they would create liquidity and they would buy up the market. And then that was what pushed mortgage rates down over the last couple of years into those numbers that we just never seen before. The 2s, the 3s. These are not normal interest rates in any environment. They were artificially manipulated by the Fed because the Fed created a huge demand because they were buying. How much was it, Joy? Do you remember? I think at one point they were buying, like 50 billion a month.
And then on top of that artificial mortgage bond buying or whatever, we also had that money pumped into our economy to supposedly, soften the blows of COVID and the restrictions and all of that. So we have a self-created recession, y'all. We have a self-created. We created this.
Yeah. Yeah, not only the recession, which you and you even alluded, like there's an argument of what is a recession, and most people identify a recession as 2 quarters of negative GDP growth. So we are quote unquote in a recession if you use only that factor. I've talked about this on other calls here that we're not truly yet in a recession. If you look at all of our economic data right now is showing the economy is still doing fine. In fact, just this week, we had consumer confidence. Consumer confidence readings are a little bit of a lie, though, because consumers get confident when gas prices go down. They think the economy is doing well because most of America, unfortunately, lives paycheck to paycheck. And as gas prices come down, we feel a little bit safer, and that tends to give people. But other reports, like on Friday, we're going to get the PCE inflation data, which is the personal consumption expenditure, fancy name, but it's an inflation report. And it's actually the Fed's favorite inflation report. And we're going to see that inflation is still ridiculously high, but has it gotten a little less high? Has it gotten a little lower than where we were last month and the month before? Inflation is caused because we have, as Joy had just said, we had what's called fiscal stimulus. And this is really important.
Also, aka also known as fiscal irresponsibility.
Yes, I absolutely agree. So we had fiscal stimulus, which is when the government, this comes from the government, when the government is just throwing money. Everyone thinks the Fed prints money, but that's a different thing. The government is just throwing money into the economy. And what happens is we've had so much money into the economy, it overheats the economy and it creates inflation because there's too much demand and not enough supply. Now, we could get very deep today and talk about supply side inflation, wage inflation, demand and consumer inflation. But what I kind of want to keep it a little bit a little bit simpler and say that when you have fiscal stimulus, I want you guys to think of it like I took this can of bubbly, and I'm not drinking on the job. This is bubbly, right? So if I took a can of bubbly and I pour it on my desk, well, I'm going to have all this liquid all over my desk. Well, somebody's got to come along and they got to mop up that extra liquid. So if I spill this water all over my desk, I'll give you guys a little bit of a better, oh, there we go. Okay. So if I spill this bubbly all over my desk, I need to come along, and this is the Fed. This is my Fed rag, and they're going to come in and they're going to mop up all that extra money that is going out there. And because the government basically has to say, okay, where is all this money going to come from? The Treasury has to borrow to put that money out there. Well, when they borrow all this extra money, now we have way too much money in the economy. We've got all these different things, too many trades. So the Fed comes in and they say, okay, we're going to print money on our end and we're going to buy that up. So they're the ones that are mopping up the extra bubbly that's out there all over my desk. And so that is called monetary stimulus. And that is what we experienced as we went through COVID. By the way, do you guys care about any of this stuff? Give me some comments and let us know, because I feel like, I mean, there's a handful of you on. At least let me know that you guys are getting it. I know people watching the replay. So the monetary stimulus is when the Fed was buying up all the extra bonds. They were buying treasuries. They were buying mortgage-backed securities. So specifically those two bonds, and they were keeping rates low. And
I feel like they were like, you get a piece, you get a piece, everyone gets a piece.
Yeah.
I mean,
well, and what, so the reason that I wanted to go deep on this is actually when we go back and look at where mortgage rates have jumped in the last week, specifically on Monday. So on Monday, where's the dates here? So
we want to talk about Monday. We don't talk about Bruno and we don't talk about Monday, man.
But you have to see. So Monday, what happened Monday, and the reason Joy is scarred for life is that if you guys look at these fancy little charts here, this giant red line means that your mortgage rates jumped. Okay. Every time this goes down, the price of bonds is going down, which means your mortgage rates go up. And on Monday, this was Monday right here, we had, not only did we have a terrible day last Thursday after the Fed meeting, that's this first red line. Then on Monday, we had another terrible red line. And Monday's terrible red line, we can blame this like we can blame everything on England. So this was 100% England's fault. That we had terrible mortgage rates on Monday. And you guys say, Hammer, what does England have to do with our mortgage rates? Well, what happened is we are in a global economy. So our bonds, European bonds, England's bonds, bonds over in Australia, all of these are all interconnected because traders are buying and selling and manipulating currency and all this really goofy, complex stuff. And what happened in England is that their Chancellor of Finance came out and said, hey, I've got a great idea. We're going to go ahead and we're going to do some of that fiscal stimulus, even though we're already experiencing 10% inflation. So England's inflation even worse than ours. And they are doing fiscal stimulus because they are panicking that their people are not going to be able to afford energy because of the war with Russia and Ukraine, because of a lot of other things that factor into that. And Joy and I probably share a lot of similar views of they've created a lot of this problem. Well, now they're faced with their people are not able to afford their energy. And they're a very socialistic country over there. So their answer was the government's going to step in. We're going to cut taxes. We're going to push money out there. Well, the problem is England has 10% inflation. When the government pushes more money out there, that's fiscal stimulus. Well, what's that do? That creates even more inflation. And everybody is like, wait a minute. The other side, I kind of put it into a mom and dad relationship. So dad is the government, mom is the Bank of England and their central bank and their monetary policy. So right now, you've got dad just printing money and throwing it at the kids and raising their allowance and basically creating this huge problem. And mom's got to clean up the mess. Now, mom's already been trying to deal with the fact that the kids' allowance was already higher during COVID, and they're not doing their chores, and they're not doing they're just not behaving. So mom's trying trying to, she's trying to discipline, and she's trying to hold everybody accountable. And that's when you had the Bank of England raising interest rates, and they were supposed to do what's called quantitative tightening. Quantitative tightening is the opposite of quantitative easing. And that is when, instead of buying everything up, they start to let their stuff sell back out. And quantitative tightening is how they reduce their balance sheet, because eventually they can't just keep printing money, right? They have to try to get things leveled out again. So you have quantitative tightening. So the Bank of England had announced that they were going to go ahead and do quantitative tightening. They were going to start to sell off their bonds that they've been buying through COVID, and that they were going to raise rates. And they're doing this because they need to fight inflation. That's exactly the same conversation that's happening in households, like the mom and dad analogy, or in countries across the world, including the US, with our Fed, who has been raising interest rates and quantitative tightening, who is now, instead of buying up all these bonds, they're now letting them back into the market. Even, again, that one we can go deeper on. But so anyway, on Monday, the government said, we're going to throw all this extra money into the system. Today, we actually see a lot of green, and we see a lot of things improving. The reason we're seeing them improving is because of these headlines right here. Bank of England steps back into the bond market to restore stability. So what happened? Yeah, I mean, that's so, and it's kind of a really ugly situation over there. So what happened is you got politicians making these decisions that are really just based in very poor economics, and they don't understand the butterfly effect of what they're doing. They almost crashed their economy over there. They're called gilts. And they should feel guilty. They're called gilts over there instead of treasuries, but their gilts had hit levels they haven't seen since the 80s. It was utter chaos Monday and into yesterday. So the Bank of England said, okay, we have to fix this, because again, the dad made a really bad error. Mom's got to step in and fix this now. So the Bank of England has staged a dramatic response to the market fallout from the government's historic tax cutting plans, announcing a plan to buy long dated UK government bonds in whatever quantities needed. So now they have done a full 180 degree turn.
Back it up. In whatever quantities needed.
Right. So what's going to happen is they're only kicking the can down the road. They're creating an even more inflationary position, but they had to do it in order to stop the bleeding and to stabilize the markets there, because like you can even see with this article here, the central bank warned that continued dysfunction would threaten financial stability, even damage the economy. It delayed the start of its plan to actively start selling its existing holding of bonds, due to begin on Monday. So on Monday, they were supposed to sell. They've done a full 180 degree turn, and they said, okay, now we're going to buy, and we're going to buy whatever's necessary to calm everybody down. Everybody gets candy. Everybody gets candy. Calm down. Okay, everybody.
Hammer. It's like the kid starts throwing a fit, and then they're like, whoa, I didn't mean it.
Yeah. And then they go back on. And exactly. So all of this stuff, that's why as a consumer, you say, Hammer, I listened to you a month ago and you said rates weren't going to go high. Well, they shouldn't have. And again, I say shouldn't, because according to everything that we were looking at, everything was just going along, making sense. Our Fed was taking a little tough love. They were a little slow to the party, but we had some tough love, and we know that eventually that's going to curb inflation here in the United States. We had been raising rates. Things were in an area. That's why at the end of July, we had VA rates were in the 4s and the low 5s. Now we're in the 7s. Why is that? It's because basically the all of the economics here went off the rails. And that leads us to the second part of this conversation. I know today was a long conversation. Today, everything's off the rails, but it's going to return. We're going to get it back on track. But in the meantime, we now have rates that are at 7% or maybe 6s, and you're paying money. And what does that actually look like? So let's talk about what you as a consumer, what you're actually seeing today when it comes to rates. So I asked,
first of all, this is today. This is not Monday. If you had to lock rate Monday or even yesterday, I am so sorry.
Yeah. And that's rough. And that's the thing. And when it comes to the timing of locking, when we're in such a panic position, for those of you that don't know, I mean, I have a lot of I counsel thousands of loan officers all across the country on should they advise their borrowers to lock or float. In the last couple of days, we've had to be in a stance of locking because of just not knowing how bad it was going to get. So you don't know, like we wouldn't have seen improvement today. In fact, there's a lot of variables that we look at when we talk about this stuff. This 10-year treasury is currently at 3.79, right? We round off this last digit. So we're at 3.79. However, this morning before open market trading, we were over 4%. This 10-year treasury has not been over 4% since the early 2000s. So we were over 4%. If we didn't see this Bank of England announcement and we didn't see this reaction, which has affected our economy so strongly, we would not be in a positive position today. So it's always easy to look back and say, well, if I had known yesterday that the Bank of England was going to do this and the markets were going to react that way, well, then we all would have said float. Let's wait till tomorrow. It's going to get better. But we didn't know that that was coming. This was a surprise announcement. So very realistically this morning, we would have been looking at rates that were even worse than yesterday.
And well, here's the bigger issue, Hamer. If you look at the chart, go back to the chart.
Okay.
Okay. The reason why this is so hard so fast, look at the chart, look at the trajectory. It goes up, down, and then it just starts. And the two red longest lines were very close together. That is why, because normally when rates creep up, they creep, right? It's not normal to have such a big decline so fast. That is why everyone's flipping out. You know, the average rate in the last 20 years has been around 6 or whatever. And here we are at 7 and we're flipping out because it happens so fast.
Exactly. I agree. I agree 1,000%. And if I were to flip this chart on its inversion, y'all, then it would be a rate chart. So as you see this going down, your rates have actually gone up. And you could see what Joy just said, which was look at this boom, boom. And I'm going to put this over a 5-year so you guys could see the performance. And this makes it even more apparent. We normally see small moves and we see trends. Like here, rates went higher. Then rates went lower, right? So, because in September of 2018, we were dealing with presidential stuff and we had rates went up, rates were pushing up here. Then they got a little bit better. During COVID, you could see we saw crazy action. And this, I remember back in March of 2020, we were all flipping out because we were seeing mortgage rates move a point in a day. And that only lasted a little while. And this was due to COVID, the reactions to COVID, the market reactions, liquidity. The Fed stepped in. Now that's why we had all the stimulus, monetary, fiscal stimulus we talked about, and things improved. So now rates got to be their best levels. Again, this is inverse of mortgage rates. If I flip the chart on its head, that's your mortgage rates. So things got to their best levels. Then as we start to come back down, now we expected 2022, which you can see starts right here. It's a January line right here. We expected 2022 to see a more similar reaction to what we've seen before, where things kind of move in a trend. We know that they're going to, well, all of a sudden, 2022, we were just like, whoa, 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 boom. And we went from rates in the 2s and the 3s into the 4s and sometimes into the 5s. And people were like, whoa, this is terrible. Oh my goodness. Now, but look at this drop here. Then we leveled out for a little while. And then we saw another drop because inflation and reaction to inflation. And then the last couple months, though, into June and July, we saw some craziness in June, but in July, we were actually recovering really well. And rates were hitting, like I said, high 4s, low 5s, which everybody had grown accustomed to being a good rate. And then now, since the beginning of August, you could see that is that move lower. And it was almost like we were sliding towards the edge of the cliff, and then we fell off it.
And here's the biggest issue. This is why it matters. This is why you have to keep up with this. If you had a pre-qualification letter from Friday, from Thursday, guess what? You need to go back to your loan officer and you need to tell them, hey, based on my credit score, what rate am I really, do I need to be qualified at 7% right now? And I would. That's what I'm doing. I'm qualifying at 7%. Now, pray to the Lord in heaven that they don't get that rate, right? But I'm qualifying at 7% on VA loans right now.
And let's talk about that a little bit. So let's talk about the fact that today, even though I read improved because today's rates are better than earlier in the week, these rates suck. And I'm going to write that down. And I think everybody can agree. And I don't know if Christopher calls that a curse word. So I'm going to say these rates are terrible. but I'm gonna write they suck.
I'm sure Nene calls it a curse word, Hammer.
Okay. So yeah, so we gotta make sure. So we're gonna say these rates, and we're gonna say are terrible, and we all know this, right? Now, here's the problem. Okay, you know these rates are terrible. I know these rates are terrible. The lenders know the rates are terrible. Wall Street knows the rates are terrible. No, it's like hot potato. Nobody wants to have these interest rates because everybody in the quote in the know, they know that when we get into that real full-blown recession, and it's coming hard, when unemployment goes up, when people don't have money to spend, when the consumer confidence drops through the floor, when the inflation starts to finally go down because people aren't spending money, rates are going to drop. What happens is, and let me just again, I'm jumping around different screens, but what happens with the Fed is the Fed had lowered rates for COVID. Okay, so this is COVID, and I'm drawing a chart for you guys to kind of get an idea here. So they had lowered rates, and rates stayed very low, and this is the Fed funds rate, and they manipulated all rates across the market, across everything to stay low. Why? To keep money moving, to keep people spending, because I mean, listen, I'm going to get on an airplane tomorrow morning. That plane is going to be chock full. They're probably going to need a couple people to hop off. They probably sold more tickets than they had seats. But yet a year and a half ago, I literally have a picture where I was the only person on a plane. The entire plane, I was the only person on it. That's what happened during COVID, and people weren't spending. So rates were pushed down to keep money moving, to keep people spending, to keep businesses going. And then now the Fed is raising rates, and they've done it here, then they raise it again, and then they raise it again. And as the Fed is raising rates here, it's going to come to what we call a terminal rate. And that's basically where they're going to stop, because what they're trying to do is they're trying to basically apply the brakes to the economy so that it creates a condition where there's less demand, which will allow prices to fall, which is what stops inflation. So right now, the terminal, as weird of a number as it is, because they actually go in quarter point increments, but they're calling it 4.6. And right now, if I jump over to a different screen and show you guys, this is Fed futures. Right now, we are currently at a Fed funds rate of 3.75. I have to double check. I have to keep up. No, so we're at 3%. Okay, so we're currently at a Fed funds rate of 3%. The probability of the November meeting, which is little about about 6 weeks from now, of this one coming in, they think the Fed is going to raise rates again, 0.5%. And then another half believe they're going to raise rates 0.75 of a point. And the Fed has raised rates 0.75 of a point now for the last, the June, July, August, or June, July, and September meetings rather. So we've seen three quarter point rate hikes. This is kind of important because what this does is it tells us where do the markets think that the Fed is going to stop. And that's the terminal rate. And then that's going to kind of figure out where all the other rates fall after that. So in December, everyone believes they're going to go up to somewhere between 4 and 4.25. By February, we're expecting to see 4.25 to 4.5. And that's basically where that terminal rate comes in. They call it 4.6. I don't know why, but really, I'm just going to, for realistic, I'm going to call it 4.5. So what happens is when the Fed gets here, that they're expected at this point to stop raising rates and to just hold it there for a while. That's still going to slow the economy down. It still keeps their foot on the brake. Once the economy starts to slow down, now this is bad. Have you ever seen one of those action movies, Joy, where like they've got a scheme and the person's going to take a drug and it's going to stop their heart, and then they they sneak them into the building, and then they've got to resuscitate them. They got to stab them in the heart again with adrenaline and, rejuvenate them and wake them back up. You ever seen one of those? Or do I watch too many movies?
I'm a huge superhero.
All right. So what happens is the Fed is going to hold these rates for a while. And there's an argument over how long they're going to hold them. But once they see enough signs that the economy has now gone too far the other way, they're going to start to reduce that Fed funds rate again. And
I've got a way better analogy. They're just going to hold our head underwater until we almost don't breathe, and then they're going to pull us back up.
Right. Exactly. And so that's a great analogy, Joy. And when they lower the rates, when they let our head back up, mortgage rates are going to come back down. But we don't know when this is going to be. Is this going to be 2023? Is it going to be 2024? And that's why everybody speculates and forecasts. And that's all because we all think, what may happen. But when this happens, mortgage rates will fall. And nobody right now wants to get stuck with this hot potato of these other rates that we talked about, and this 6.5 and the 7%, they don't want to have these, because what's going to happen is these ones, you think, hey, they're getting this great interest on these if they go up too high, but there's no liquidity. Just bottom line, they don't want to get there because all these people are going to sell off and get rid of those mortgages. So it's kind of like chipping away. If I have a 6.5, remember I talked about right here, if one of these 9 go away, well, we still have a strong bond. But what happens if out of the 9, they all refinance, or, let's say just 2/3 of them refinance, or maybe even a little bit more than 2? Well, now all of a sudden, you don't get that rate of return on that bond anymore because the interest isn't coming in. Your principal is still guaranteed, but you're not getting the interest, because that interest was based on how many of those people are still in there. And if that bond, again, this is a complex topic, but this is how it works. It's simplified. If that bond loses its value because everyone refinances because rates went down, now they're stuck and they don't have anything. So nobody wants to buy these really expensive bonds. And that's why your mortgage.
We saw on the page, people were concerned because they can't they can't get a rate without points. This is what is happening, guys. This is exactly what is happening. I had it happen on Monday, and it pained me so much. But the reality is that that's what we had to do. And so my rate sheet wouldn't go above 7. It wouldn't go above 7. And I was like, man, I really need them to get, because the buyers would accept higher rate. They would. They could do it. They planned for rates to go wherever. And instead they ended up paying some. And so Monday, was very stressful.
And life's going to continue to be stressful. So I asked Joy to work up a scenario. Let's say that you're a consumer and you've got a 680 FICO score, which is your credit score. You're getting a $350,000 loan. And again, this is an example, and it's not an offer to lend. We got to put that out there so that you guys know. This is just for us to show you. So Joy, let's go through those numbers a little bit. If we have, our consumer, Roger Rabbit, he's always my example. So if we have Roger Rabbit, what would you tell Roger his mortgage rate would be if he's going to lock in that rate today? Where does he come in?
About 6.5% right now. And this is on a VA loan. This is not
okay. So it's on.
It's on a
so
VA
this is on a VA loan. So 6.5%. And is it going to cost Roger anything, or is Roger going to get any credit on that rate?
Roger could go higher and get some credit. Right now, it would just be $1,500 for like origination, processing, that kind of stuff. Okay.
So, but let's put all the other fees aside and let's just look only at rebate or credit. So the 6.5, is that what we call par then? Is it going to break even?
Yeah.
Okay.
6.5 is par.
So this is what we call a par, folks. And just like in golf, par is that level. It's that expected level. So 6.5. Now, let's say that Roger wants to get a better interest rate and he wants 6.375. How would Roger get 6.375?
6.375 is going to cost Roger about $2,500.
Okay. So Roger's going to have to pay $2,500 to get 6.375. And then what about 6.25? Do you have that one more?
6.25 would be 6.25 would be, let's see, an extra 1,000, about 3,500.
Okay. And then what if Roger wanted to get money back and towards his closing costs? So let's say he took a rate at 6.625.
6.625 would only get him $1,000.
Okay, so this is a credit. So these, I'm gonna put a credit inside a parenthesis because that's actually a credit. That's money that Roger gets. And then this is what I love about this fancy little remarkable tablet. Since I didn't give myself enough room, I can move that down.
That's fancy.
Yeah, see, isn't that cool? All right. And then let's say now at 6.75.
6.75 would give him about $1,500.
Okay. So what you're looking at, everybody, is that, and this is a scenario right now that is kind of unusual because, like you said, Joy, did you have the ability to give Roger a credit back on Monday?
No, on Monday, Roger would have had to pay about $6,500 for a 6.75%. And there was no option to go higher.
Right.
It was
And that's what I kind of want to talk to everybody about. So what's happening is rates have hit a ceiling, and this is my drawing of giving us a ceiling, right? Rates have hit a ceiling because on that back end that we showed you guys with the coupons, there's nobody buying. Everybody is like, hey, I've got these for sale. Crickets. Nobody's buying. Nobody wants them because they know that people are not going to be in these rates a couple of years from now. The likelihood, nobody knows the future, but the likelihood is very low that people are going to be in these rates. These rates are caused by our current economic condition, which we have no control over. And you've got to keep telling yourself that, because it's frustrating when Helmer said, don't worry, rates are going to get even better at the end of the year. And you're like, Helmer, you lied to me. The reason I lied to you unwittingly and unknowingly was because based on the economic conditions a month, 2 months, 3 months ago, that's what we were looking at. That's what was
technically
forecasted.
You have time to make that right in November and December. So
right. Do you think rates will, and that's a question though, do you think rates will come down significantly in November or December?
So here's the deal. The last time that we had a course correction, when was that, Helmer? The first time that rates came down.
Okay, so that was in June. That was June 10th because of inflation data that came in on June 10th. Rates went up on the 13th and 14th.
Okay, so here's the deal. Investors, lenders, all that, they are hedging on what they think they know in the next 120 days. They are hedging on that. And so what is going to happen, I believe, is that they are hedging far beyond what the risk that is going on right now. And I think what we're going to see in about 60 days, maybe it'll take 90, is that things are going to back down a little bit. Of course, it could go the other way. Bank of England, we're not going to do this. And then they did, right? So we have that variable. And then we have the Ukrainian crisis with the energy. The world, the world is in an energy crisis almost, especially Europe. And so those factors, investors, lenders, all those people, right? They're hedging on the fact that this is what we know. We're going to make it awful because we don't know what we don't know right now. We just know this. So I'm speaking in very general terms, but I think at the end of the day, it's going to end up getting better in 60, maybe 90 days. I honestly believe, though, the big turnaround will come in February when we get the fourth quarter data. That's when I think everything is going to change. Now, will it be life-changing for people as far as interest rates and stuff like that? No, because things can shoot up and they go back down very slowly, normally, right? But these aren't normal conditions either. So I'm saying a lot of maybe, things are volatile. Volatile is a good word right now. But yeah, I mean, generally, if I were purchasing a home, if I were doing a new build, let's say I were doing a new build, I would not be doing a long-term lock right now. If I were going to close in January or something like that, I would be not doing any kind of long-term lock. If you have to lock in the next few days, if you like it, lock it, because it can always get worse. It can always get worse.
Especially in the near term. We could actually see rates push up into the high sevens at this point if we see more of a negative reaction in the markets that we've shown you guys over here on these fancy charts. If we see more of this drop, then things could get bad. And remember something, today, if I put this into just into say 2 days here. So today we've seen things get much, much better. Look at this go up, which is good for mortgage rates. Well, if we didn't get that Bank of England news, we very well could have continued this trend over the last 5 days, which is worse, tried to recover, still got worse, and then boom. So today's, great news doesn't put us in a position to change that longer term trend, which when we look at, here, we see that longer term trend, which is things are getting much, much worse. Rates are moving higher. So keep that in mind. And kind of to move that in, though, is now a good time to buy a home? The answer resoundingly is still a yes. And I, just to prove that I put my money where my mouth is, my daughter and, son-in-law are closing on a home today. So I still think it's a phenomenal time to buy a home. My brother is closing on a home next week. All right. Now, what could happen is if you buy a home we've got, will prices, are we in a bubble? This is one thing that comes up all the time. Are we in a bubble? Are we going to get a repeat of 2008? And the answer is no. But what does happen, and I got to try to here. Let me see if I can go through these a little bit faster to get to
You talk a lot,
this
man.
chart. I do. I told you that jump. I told you jump in and actually you've been a great guest
Awesome.
because I'm used to doing these by myself. So when you've got this chart here, we've talked about as rates go low, prices go up. And that's exactly what happened. Rates went low, prices went through the roof, because when you've got cheap money, same problem that we have with student loans and tuition. College tuition, ridiculously expensive when you look at how it's gone up the last 20 years, because we have a generation that had the availability of very cheap and easy to get money. And that's what happens here. But the affordability, this middle dot, this doesn't change. People's income did not change in the last 3 months. People didn't start making double the amount of money. So as rates go up and we look at the blue line, well, what happens is that affordability, in order to level out, it's a fulcrum. So now the prices would fall. However, we've talked about this before. We've seen what's called deceleration versus depreciation, because we were in an environment where things were so ridiculous and house prices were not going up at an average of 4%. They were going up at an average of 20%. People were in bidding wars and they were waiving appraisals and waiving contingencies and all these things. Well, that has slowed down. And we had talked about on some past ones of these, I said, hey, we're seeing deceleration. Homes are still appreciating, but just not at this ridiculous rate. Well, now we're finally just starting to see reports of depreciation where values are going to come back a little bit. Is it anything to panic over? So Joy, you said I talk a lot. So tell everybody, should they panic over the home prices coming down?
Well, here's the bottom line. The last 4 of 6 recessions, the recession was the last 4 of 6 were really actually good for real estate. The biggest one that was an issue was 2008, but that was due to a lot of irresponsible lending. You could say I made X amount of dollars and get a mortgage. The other one that was an issue, it caused a little bit of depreciation, but actually it turned around very quickly. So the answer is no, don't be concerned. But here's what I would do though. If you have not purchased a home, I would get a home. And here's why. When those interest rates go back down, the people who have been waiting and feel like, oh, interest rates are really high now, guess what? That's going to spur more demand. We already have a demand issue just because of sheer numbers. It's a numbers game, right? Supply, demand. We don't have enough houses. We have a lot of buyers. Hopefully that will, level off. But when interest rates fall again, you're going to have more of those multiple offer situations. Right now, I am helping a veteran close on a home. The builder came back. So he signed the contract with no seller's concessions whatsoever. 30 days later, the builder said he can give him $9,400 for closing costs. Great. Now, I said, man, these rates have gone crazy. You got to help us out. And the builder is now giving the buyer almost $15,000 to close.
And same thing with my kids. So we went into a contract of $300,000 and it was bought by Open Door. And Open Door is what's called an iBuyer, folks. They actually have just algorithms and they buy houses. They then do some very, very small improvements like painting and refinishing floors. And then they'll generally relist the house at maybe 10 or 15% profit and they'll look to sell it. Well, my kids, they bought the house for, and I'll erase this in a minute, but they bought the house for $296 in May. This is Open Door. Okay, so Open Door. And they bought the house for $296 in May. They tried to list the house for $327 in June after doing some nominal improvement. And then that continued to start, because this is when rates were starting to go up. So this fell, 327 fell to where we offered 300. And then after just the kids found out there were a couple of things in the house that needed to be repaired. And we went in and said, we want a $20,000 price reduction. And we had it within a day. And the only reason that we saw this is because Open Door said it's cheaper to give $20,000 today than to have to relist the property when this contract falls through and to make maybe $20,000 or $30,000 less later because prices have continued to come down. So the one thing to note about housing prices, as we go over this, is that normally when rates drop the way that they did and they drive prices up, rates go up. Now prices should really drop, but they're not dropping as fast and as hard as we should see. And why is that? And it's because of supply. We've got not enough buildings since 2008. We've got overregulation. You've got lumber costs, which have finally fallen, but still the building. And then there's one big thing that's different than ever before. There's more people that have 2 or 3% interest rates on their mortgages. And these are people
that is
well, it is. And it's something that we've never had this before. So what happens is if I love my house, but now I'm having another baby and, Joy's got 5 kids, maybe she decides to have 7, next ones are twins, Joy. So now Joy says, I need a bigger house. But if Joy's house has got an interest rate of 3.25%, how do you go into a more expensive, bigger house at an interest rate at 7%?
Well, and we actually have this scenario. We're building a casita in our backyard,
Mm-hmm.
because I told my husband we're all going to be buried by the pool. We have a rate in the 2s. I'm not even joking.
Yeah.
The affordability factor when you get a rate in the 2s is incredible, right? It would be double my mortgage payment right now. And, we got 5 kids, right? And so I'm not the only one in America thinking like this.
Yeah, exactly. Same thing. So that's why we have this, I don't want to call it artificial, but this unique variable that we normally don't have, which is going to keep supply down. And that's going to help keep that supply demand ratio in check, even though we've seen when rates go up, demand comes down. When demand comes down, supply usually goes up, which drives costs down. Instead, we're seeing supply still stay low. And that's
why those VA loans are so important, because there is the ability to assume the loan. And that hasn't really been a trend in a long time. But guess what?
Yeah,
it will be now.
Yeah, it definitely could be. But even still, anybody that's moving out of that house is faced with that same predicament.
Oh, yeah.
Somebody could assume their mortgage, but you can't take a mortgage on your current property and bring it with you to a new property. So they're still going to have that newer.
I see that happening is if like veteran, I'm in a big vet community. I'm in near Fort Bliss. And so there's lots of people it would take the perfect storm, right, to do that though. You have a VA loan, you will assume a VA loan. But anyway, the fact you can do that is huge.
So the answer though is still yes, it's a good time to buy a home. You may be able, number one, you're going to see some deals out there. Number two, you're not going to get outbid and outrun for houses. You're actually going to get contracts accepted. Whereas just a year ago, the conversation was, how do we set our contract apart so we can get it approved? We've put in offers on 6-7 houses and we haven't been able to get any of them. Now you're going to get those offers approved. So don't get so worried about that. Prices may come down a little bit in the very near term, but once we go into the other side of this, basically, I'll just draw it like this. Right now, we're at the apex and rates are at their highest. When the economy does start to slow down and rates do drop back down again, home prices are going to come back up. Joy, do you agree with that?
Absolutely. And also you have to think about what money could you save and keep in your pocket right now that is a savings to you, versus, closing costs can get expensive, especially in Texas with the taxes and things like that. Yeah. So what can you keep in your pocket right now to kind of weather this time and still get a home, right? And then when that opportunity comes for refinancing, guess what? You essentially save money because someone else paid that for you. That's huge.
Yeah. And then so to kind of wrap up, and again, I know today was really long. Hopefully, I wish I would cut pieces of this because I think there's so many different valuable chunks, Joy, that we had today. But if you, first of all, you need to shop around for lenders and recognize that, like Joy today is able to offer a higher interest rate and give you a credit. Okay. Some lenders may not be in that position. They may not have that rate sheet available to them. They may only be at 6.3, or let's say they're at 6.5 and you still have to pay $1,500. So that's why shopping around is important, and working with the professional that you trust is important. When things are moving like this, that's the key too. I'm very big on relationship and trust, and trusting who you're working with, and let them do their job. It's not that if you've settled on somebody, I'm not telling you to shop around, but we do always talk about shopping around before you settle on somebody. And once you, right now, you have to talk to that professional and you have to decide what's important to you and where you want to be, and think about in terms of this year, next year, the year after that. Of course, nobody should ever buy a home they can't afford. Mortgage people will always do their best to make sure you don't end up in a situation of buying a home that you can't afford. We're not proposing that you should ever go in over your head. However, if you do, let's say right now, if you believe like I do, and again, this has to be from you though, if you believe that mortgage rates are going to be cheaper a year from now, and that you'll be able to take advantage of that EARL, that interest rate rapid refinance loan through the VA, you need to have this loan for about 7 months anyway. And again, that's an about, talk to your, but it's 210 days, et cetera, or 200
and six payments,
right, six
210
payments.
days,
Okay.
both have to be met.
Okay. So, you're generally looking at about 7 months. So if you're thinking of that, maybe you decide, hey, I'm going to take this interest rate because it only raises the payment by, $20 or $30 a month, but yet I can get a $1,500 credit towards my closing costs. Maybe what I would not suggest doing in this market, and again, you've got to do what's right for you, but I would not suggest buying down a rate to here unless you need it to qualify. And that may happen sometimes, guys. It's a very tough situation for everybody to be in right now. You may have been qualified at 6.25. You may not qualify at 6.75. So maybe you do need to put some money in up front and get to this. And if you do, maybe you go back and say if the seller can contribute towards that, or these are things conversation.
Let the agents, let the agents do their jobs. That's why you work with professionals. Let them know what you need, because your sellers need to sell. If they're in that position and you have an accepted contract, your sellers need to sell.
And somebody put in here a note about like a 2-1 buy down. So, this was one of the things, a 2-1 buy down. Can you please explain to everybody, in simple terms, and I'll draw it out as you're doing it. What is a 2-1 buy down?
Yeah. So let's say that the note rate is going to be 6.5%. Let's just say that the note rate is 6.5%. However, let's say that you get some seller concessions to get a 2-1 buy down. So for the first year, your interest rate is going to be 4.5. It's going to be 2% lower. And then the second year, it's going to go up to 5.5. Guess what? Hopefully you get to refinance in between that first and second year. I mean, truthfully. And so, but by the third year, if you haven't done that, let's say stuff happens, you can't refinance. I don't know. By that third year, you're back to the note rate of 6.5. And that is what you have to use to qualify. So right. If you cannot qualify at 6.5%, the 2-1 buy down will make your payment better, but you still will have to get it down to qualify.
Right. So again, for qualification purposes, we, if I roll back a couple of them, we talked about maybe you qualify at 6.25 and not at 6.75. But I didn't realize there's so many pages in here. So anyway, the 2-1 buy down though, what makes that more appealing than just buying down the rate?
Because the 2-1 buy down makes your first year really low. I mean, you can't even get a 4.5 right now. You can't even get a 5.5 without paying. Let's just say you will likely have to pay so much it won't even pass the points and fees test. Basically, it's too expensive, so no one's going to let you do it.
So for that $3,500, cost, if you were going to pay $3,500, you might have gotten 6.25. And whereas with that 2-1 buy down, and how much does a 2-1 buy down generally cost? Do you know off the top of your?
Let me look. I priced out a conventional scenario yesterday. It was a $350,000 loan amount and a credit score of 700, and it was costing about $7,000.
Okay.
I mean,
so let's say that you have $7,000, to spend, and it doesn't have to be your money. Again, this is something that you can go to the seller and say, I want to buy the house. and look for what's called a seller concession. Talk to your mortgage person, talk to your real estate agent to understand these terms. And if you had $7,000 to spend, what's the best way to spend it? You have to decide, well, if I were to take that $3,500, I can bring the rate down to 6.25, and then let's argue that 7,000 brought it to 6, right? Just to be, so we put it on here. So that $7,000 may bring your interest rate to 6, where for the life of the loan, the whole loan, it'll stay at 6%. But if you don't plan on having this loan in a couple of years, because if you believe like we do that rates will go back down, then what's going to happen is you can spend that $7,000. You'll get a much more dramatic payment difference by lowering the interest rate for the first year by that 2%. You're getting a lot more savings up front. Then you get savings in the second year. And then the third year, if we didn't see mortgage rates get any better, you're going to be at that 6.5.
And I'm telling people, what's more important to you right now? Is your monthly payment more important to you, or is keeping cash in your pocket and weathering this current financial state? Is that more important? Because if someone says, hey, I can handle this payment, I just need the cash, I'm going to tell them, well, use the money to pay your closing costs. Don't do a 2-1 buy down. If you're comfortable with that payment, because here's the thing, once you refinance, guess what? That payment's going to come down anyway. And you didn't pay out of pocket to get into that house. So, but it's all what you need, right? If your monthly budget is so tight, especially with families, with children, things are more expensive. I mean, I'm feeling it. 5 of us, our grocery bill is more expensive than our mortgage.
Yeah, I can believe that.
Yeah.
So last question, someone asked, would you lock? I say yes, I would lock. Again, my thinking behind it is that today we've gotten improvement from the last couple of days, but I don't think those improvements are going to hold or continue for long. Until we see true signs of a reversal, locking is the best to protect against the volatility. Joy, what do you say?
What's your appetite for risk? That's my question. What is your appetite for risk? If you want to bet on it, bet on it. If you want to let it ride, let it ride. If you like it, lock it. But I was saying that when rates were in the 2s as well.
Yep. And then the one thing I'll add to that, though, is always not only your appetite, but risk, but can you afford it? That, of course, is the ultimate if you can't afford interest rates to go higher, and that's going to knock you out of qualifying, then of course you need to lock in what you have that's protected, because that's guaranteed so you can buy your home. Whereas if you wouldn't risk your whole transaction, and we could see that kind of crazy movement, we could see a 0.5%.
Well, we already saw it. I mean, if people got in over the weekend and they were qualified at under 6, now it's going to take some serious cash to get them in qualification. So I mean, that we're there. And appetite for risk is exactly now. Can you afford to risk it? Can you afford to risk it?
Could you afford if rates went into 8s? Because I said they're not going to go into the 7s, and here they are. So I'm not going to say they won't go into the 8s.
I believe we will see conventional rates in the 8s.
Yeah. So with that, with where we're at now. So here's another question. And by the way, I don't know who this is with a Facebook user. So when you say lock for 90 days, are you a consumer or a mortgage professional that are asking that? I'm curious, because my answer to locking for 90 days is almost the same thing. If you're a consumer, you could lock. And if rates were to improve dramatically, a 90-day lock is more expensive. The longer period of time you are guaranteeing the rate in the future, the more expensive it is to guarantee that rate. So when you factor that in, if you were to, all right, so an LO new construction, because as an LO, do you have the ability to move the loan? Do you have a float? Do they have a float down policy? Yeah. But otherwise in this environment, the risks are locking, not because we don't think that rates could be better in the future, but because we don't know. And there's such an opportunity that they could be even worse. So a day like today on a healthy rate sheet, where, as Joy pointed out, it's so much improved over Monday, you let that borrower, I mimic Joy's thing. What is their appetite for risk? Can they afford to take that risk? If rates were to be into the 8s, would they still buy that home? And if not, then it's a definite, easy decision to just lock it. Even if they could, I lean towards locking today. That's me. Joy, would you like to answer that?
I live in the gray. I mean, every borrower, it is so dependent on the transaction, on the profile of the borrower. I have some people going through new construction. Their home is likely not going to be done on time. And if it pushes out to that 90 to 120 day mark, it honestly doesn't make sense for them. And so, and also I have some borrowers who aren't going to buy in the next 60 days. In the next, I'm really looking in the next 30 to 60 days. Like if you're under 60 days, you really need to understand your financial picture, that borrower's financial picture, and advise them like, here's what you're risking by not locking.
Right.
And then let them make the decision.
Yeah. And like I said, normally for me, it's a snap answer to float on a 90-day. Normally for me, I'm all about floating, but I don't trust. I thought that we were going to see rates drop by the end of 2022, first quarter 2023. But I, like Joy, think that that might be later in 2023, because if we're looking at the Fed raising rates November, December, and into February's meeting, this has me thinking that we may not see mortgage rates improve with any real significance until maybe June of 2023, because the Fed is going to.
Well, here's the deal though. Mm-hmm. Who says they're not going to reverse course? Because the economy is going to get bad.
They all have said they're not going to, but we know that they could change their tune. But right. I think that if they do raise rates to a terminal rate, they're going to keep it there for at least four meetings. And that's my opinion, which is why we form, everyone's got their forecast. So I think that the Fed is going to push. I think this is pretty accurate that they're going to raise up through February. I think they'll hold until probably at least June or July. The dot plot, the Fed's forecasts have them holding through all of 2023. I don't think that they're going to make it that long. I think they're going to hold a strong stance. They have mentioned in the past that the last time we had to deal with an inflationary problem like this was in the 70s and 80s. And Paul Volcker was the head of the Fed back then. They did start to lower rates. Inflation became another problem almost immediately. They had to start raising rates again. There's a lot of Fed members today that said they don't want to make that same mistake. So I think it's going to be a bit later in the year that we see those improvements. But
yeah, I mean, I hope so. The great thing is this is America. The confidence in our markets versus other world markets is there's no comparison, honestly.
Right.
We have the strongest confidence in the market. Now, when there's no confidence in our market, that's when I'm like, oh, okay. Yeah. So, I mean, it is what it is at this point. And so the biggest thing is you guys can get in on it if you're purchasing a home or you didn't get in on previously. It's still a great time because guess what? There's a little bargaining power now, and that's huge.
And the one thing when it comes to a home that I can't stress enough is what makes it different from stocks. We talk about the financial picture of it, all right? But one thing that's never changed for me, no matter how much I've bought a home for or whatever happened to it, I lost a house in 2008 when, we had the crash, is it was the financial picture was what it was, but putting a swing set in the backyard, putting whatever color I wanted in my kids' room. My daughter wanted bright green, having the freedom to do those things that you can't do in a place that you're renting. Not only the financial picture, but it's never a bad time to own a home, guys. In my opinion, just for your own family. And then from the financial side, if you're owning a home for any period of time, more than a couple of years, 2, 3, 4, 5 years, we're still going to see a price appreciation. We're going to be looking at 2027, 2028. We're going to be looking back saying, I wish I bought a house in 2022, even when rates were that ridiculous number.
Oh yeah. And never forget that, are you going to build someone else's financial future, or are you building your own? I mean, Don't think your rent's not going to go up. Don't think that other things are not going to continue to do it. So either invest in yourself or you're investing in somewhere else.
And that's exactly.
I want to bet on you. So
yeah. And that's exactly why, for me, why my kids are buying a house right now is because they got a apartment lease in New York, in Manhattan, in New York City at the beginning of COVID. And I told them, get a 2-year lease, and they have an apartment for $2,500 that their rent increase will be it'll be over $1,000 a month, because rents have now returned to more normal levels in New York. And the landlord that's renting the apartment will probably rent it out for $4,000 a month, because he's not held to the limits on their lease for rental increase. So that's how much of a difference there is in rents. Buying a home it's a no-brainer when you start looking at that. You're paying it somewhere.
Yeah, that's insane, man.
Yeah.
Woo!
Yeah, it is. So, all right. Well, Joy, thank you. It has been wonderful having you here. Thank you I told you at the beginning, you had to fight your way into the conversation. I always have to keep a window open to keep the oxygen going in here because I do a lot of talking.
Well, my nickname embedded VA is Chatterbox. So yeah. We're in good company, man.
It was good. That's why we've been an hour and 18 minutes. But I'll tell you, I think there was a lot of information and value in today's thing. Hopefully we can reference back to it, maybe even some of the, the timestamp marks so people can kind of wade through it. If you're just coming back on this, it's the kind of thing that you could play in the background as a consumer while you're doing other stuff. Just listen to it like a podcast. Joe Rogan talks for 3 hours and people listen every day. So I figure an hour and 18 minutes, we got a shot at this. And
maybe it was great to see you. I admire you a lot.
Oh, thank you. Thank you very much. I appreciate that. So, all right, everybody, we're going to go ahead and wrap it up. Let me throw a slide back on here and show you the where we're our little end things here. So we do this every week, and we're normally shorter, about 20 minutes, 12 p.m. Eastern, 11 a.m. Central Time.
Whoa, it's normally 20 minutes?
Yeah, we're usually about 20 minutes today. I told Nathan and Christopher that we were going to go deep today on all these different topics because there's so many people that are asking about it and the rate sheets and why things are. I mean, let's face it, as a consumer right now, if you're getting your information from the media, you have to feel like you don't know anything that's going on because the media spins.
Remember, fear sells, guys. Fear always sells. Mm-hmm. My favorite advice as far as markets and all that, be greedy when others are fearful. That's Warren Buffett, right?
I almost used that quote this morning. I actually put it on I do a lock advice email every morning. And I actually had that one on there and I took it off for the fools quote I used today because I think that the government in England were fools. So I used that one instead.
Yeah. But the sentiment is look at opportunity right now. Others are fearful. They're not seeing opportunity. Those who see opportunity right now will come out. Millionaires are being made right now.
Yeah.
No joke. So use that. Don't let the media scare you. Fear sells. It always will sell. They know it sells. And so get your information from Helmer, multiple sites that he referenced. I mean, an educated consumer is a wise consumer, and we want wisdom. There's lots of knowledge out there. We want wisdom, right? Knowing what to do and when to do it. That's important.
So awesome. Well, thank you again, everybody, for joining us. Joy, thank you. Anything else that you want to say before I hit the end broadcast? You stay on for a minute, but I'm going to end the broadcast. Anything else that you want to say?
We love y'all. Thanks for being in the community. We're always here to help.
Very good. So, all right. Take care, everybody.